Hi, I'm Mike Palmer, Certified Financial Planner and founder of Ark Royal Wealth Management. Today we're going to do a deep dive on fixed index annuities, an insurance product many consumers don't fully understand. You've probably heard financial advisors on the radio talk about guaranteed income, an income you could never outlive, no market losses, and steady returns. It sounds like the perfect retirement product, right? But before you invest any money in a fixed index annuity, let's look at what you're really signing up for. Let's start with the elephant in the room. FIAs are often sold as being risk-free. But is that really true? Not exactly. FIAs are backed not by the FDIC or SIPC. In fact, there's no federal guarantee on these products. An investor in an FIA is taking an IOU from an insurance company. And if that company fails, you can face a substantial loss. Think it can happen? Look at executive life insurance in the 1990s, or more recently, Penn Treaty Insurance. Creditors and policyholders were left holding the bag for years while courts sorted out the mess. Before buying an FIA, ask yourself, would you lend $500,000 to one business with no real collateral? Many salespeople claim your annuity is invested in the market. But here's the truth. Your money isn't actually invested in the S&P 500 or anything else. You're giving your money to an insurance company, and they're promising to credit your account based on how an underlying index performs, minus the caps, riders, and fees. Here's an actual example we recently saw from a client that had been sold an FIA. In this example, if the S&P 500 index gained 10%, this product had an 8% cap. Various riders totaled 3.5%. So the contract would credit only 4.5%, or less than half the actual return of the S&P 500 index. It's also important to note that fixed index annuities that track stock or bond indices only return the price change of that index. They don't include dividends or interest. This significantly impacts your expected returns because historically, dividends make up about 40% of the S&P 500's total return. The biggest overlooked risk with FIAs is that your return is determined by what the market does on just one day, the contract anniversary date. Let's say you bought a FIA on March 31st, 2022, when the S&P 500 is at 45.45. A year later, the S&P 500 is at 41.09. So your FIA tied to that index would have had zero growth, but also no loss. Compare that to an investment in the S&P 500 index fund. That investor would actually have a slight loss for the one-year period ending March 31, but that unrealized loss meant nothing if they continued to hold their investment. Just 3 months later, in July, the S&P 500 index was up to 45.82. A slight gain from the initial purchase. This illustrates the huge advantage an investor gets for not being forced to determine the return on their investment based only on one specific day. With an FIA, you can't wait for a better day. You're locked into that one day, no flexibility. It's like being forced to sell your house on a rainy Tuesday because your contract says so. This is in stark contrast to a basic mutual fund or ETF investment. With those investments, you have the luxury of waiting until market conditions are more favorable. Your investment returns are determined by your behavior, not a contract. Speaking of locked in, FIAs usually come with long surrender periods. 10 to 15 years is common. This means that if you change your mind 3 to 5 years from now, you'd have to pay surrender fees of as much as 10 or 15% of your investment. Let's look at an example. If you invest $500,000 in an FIA and decide to exit 3 years from now, you could be losing up to $75,000 just to get your money back. Many people like the idea of guaranteed income, but here's what they don't tell you. That income guarantee comes with strings attached. Guaranteed income means that you must commence annuitizing your contract. And when you do so, you give up the ability to get a lump sum out of your money. Let's say you want guaranteed income and you start annuitizing a $750,000 FIA at age 70. You could expect about $4,500 a month. That seems pretty good, right? But what if you need $25,000 for a new roof or $35,000 for a new car? You can't get it from your FIA. And chances are that $4,500 monthly payment is set in stone. It won't get an inflation adjustment each year. If inflation averages 3.5%, in 20 years, your purchasing power will have fallen by half. Advisors selling FIAs often play on fear of market crashes and fear of running out of money. But fear isn't a financial plan. We're not saying every FIA is bad, but they're complex, restrictive, have high fees typically, and are very often misrepresented. You deserve to know exactly what you're getting and what you're giving up. Your financial future deserves more than a clever sales pitch. If you want honest, transparent advice about whether an annuity or an FIA makes sense for you, give us a call. We offer a complimentary consultation, and at Ark Royal, we're never compensated by commissions. We always serve as a fiduciary. If you found this video helpful, don't forget to like and subscribe or share it with someone who might benefit. And if you have questions or want us to cover a specific topic, leave a comment below. Thanks for watching. If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.